From Performance Property. Today we'll be doing our quarterly update, our March quarterly update, which is our first for this year. We've got Philip Almeida, one of our directors, here to run the session. So just over to you now, Phil, and looking forward to the presentation. If you do have any questions throughout, please ask them just in the chat, and then we'll run through the answers to those questions at the end. But Phil, if you just want to take yourself off mute, and over to you.
Thanks, Paul. Now, obviously, before we start anything, the advice that we're probably going to run you through is general advice in nature. So if you do want to catch up with any of our advisors here at PPA, more than happy to speak about your individual circumstances. So national, there's been a bit of stuff happening across the national markets since the last time we caught up as a business. From our end, in terms of the house price movement from May 2022 up to today's current values, you can see that the Adelaide market's done quite well. It's probably bucked the trend in terms of that consistent growth that we've seen down on the ground in that 10-kilometre radius of the CBD. So stock levels have become a lot more difficult to buy for us, and there's a lot more owner-occupier activity on the ground. So as investors, it's probably pushed us out of the market, and we're finding it quite difficult to buy good quality assets on the ground in Adelaide. Greater Hobart, we've probably seen a softening in some of the house prices on the ground, but rents are definitely moving in Hobart. Melbourne, we're starting to see an exodus of people given the recent land tax thresholds in terms of decreasing them down to $50,000 for land tax. So we are expecting probably increased land tax bills with our clients that own existing commercial and residential stock here in Victoria. So I think from our end, we probably just need to make sure that cash flow is managed effectively. Perth at the moment, we're still seeing probably a lot more opportunity on the ground in Perth, and Sydney, we're not taking on a position on Sydney right now as a business. Capital city vacancy rates. So vacancy rates across the country are still very, very tight. Anything sub 2%, we're probably going to expect further rental increases. From our end, probably the tightest market nationally that we're seeing across the ground is definitely in Perth, Melbourne and Sydney across the view. We're seeing Adelaide rents being maintained. Brisbane unit rents are starting to increase as well. And there's obviously a deficiency of stock not getting built in Melbourne and Sydney at the moment. So we're actually going to see further rental increases from anywhere between 15 and 30% over the next 12 to 24 months in both of those markets. Dwelling approvals, everyone's talking about dwelling approvals, but we know across the country, we've got a significant shortage of not just housing stock, but unit stock. What we're seeing on the ground, a lot of our builders here in Melbourne are moving up to the Gold Coast to obviously undertake larger construction and development pipelines. So in order to get really good quality trades in Melbourne, we're still finding it fairly difficult. But you can see nationally, we've got a stock deficiency of just over 160,000 dwellings. So it's still quite severe, and we don't see that changing over the next 12 or 24 months. Population movement, you can see that obviously overseas migration numbers are still very, very aggressive. We're still expecting significant numbers to come into Melbourne, into Sydney, and even into Perth. We're seeing obviously a lot of overseas migration numbers starting to hit the Perth market as well. But from our end, we're seeing pretty significant people moving into Brisbane. There's obviously a medical shortage of doctors over in Perth as well that we're experiencing within our own client base. It's interesting to kind of assess a lot of the interstate migration numbers and where those interstate migrants are moving. And we're still seeing a lot of activity into the Queensland market and the Western Australian markets. And we don't see that slowing down over the next 12 months. Melbourne, we'll touch on Melbourne, but Melbourne in that kind of $4 to $7 million range is still fairly tight. There's still buyer depth for really good quality family homes. We're definitely seeing some softening for really good quality residential homes that are unrenovated. So if you've got capacity to go and buy a really good quality home, that need some form of cosmetic improvement, we probably think there is value within that residential market in Melbourne. What we have found is a lot of our clients are starting to tie up their wealth within the family home rather than look at investing for residential or commercial stock in Melbourne at the moment. So from that end, they're probably recycling some of their debt and upgrading the family home. We're still seeing a lot of depth for really good quality renovated homes in the eastern suburbs of Melbourne and Brighton. We've seen definitely a softening of house prices at that top end in that 10 to 15 mil space. The 20 mil space is obviously still quite strong. So we're seeing a lot of activity in the kind of higher end of the range in that 20 to 50 mil space. So from our end, if you've got really good quality property, a lot of clients and investors are concerned around the increase in vacancy tax, land tax. So the government are heavily taxing the kind of Victorian investor out there. What's going to happen as a result of that? That's just going to push your rents up. So if you've got any existing investment stock here in Melbourne, I think rents are going to rise quite aggressively, and they're probably going to rise even more than, say, 20%. So we manage a lot of our clients' commercial assets and residential assets here in Melbourne, and we're actually generating pretty significant rental increases after the tenants move out. So I think the person that is obviously going to be affected from this is obviously the tenant, and that's a concern to us because they do still need to rent somewhere, but rents are aggressively rising and they will continue to do so over the next 12 to 24 months. You know, in terms of the affordability index, the affordability index in Melbourne is running at 58%. So if you look at the long-term affordability index of Melbourne, 41% is the average. At the moment, we're sitting at our affordability index kind of ceiling. So from that end, if you do want to obviously go and upgrade your family home, I think it's probably a really good time to be doing that. If you're looking at buying investment grade stock, our advice is there's probably better markets to be taking a position on outside of Melbourne right now, but there will be distressed opportunities that will start presenting fairly soon over the next 12, 24 months. Price to income ratio. If you look at the price to income ratio for units and housing, you can see that, you know, the price to income ratio for housing is still running at 9.3 times. So usually when Melbourne runs at around about 8 times income, that's probably the norm, but we're still trending above that rate. Units are probably better value. You know, as we touched on the last research meeting, I think the unit market in Melbourne represents good value. So if you can buy a really good quality block of units in that kind of $2 to $3 million range and keep your land tax within reason, I think they're probably good long-term investments to take a position on. And that's running at 6.6 times price to income. Median house price, you can see for units and houses, there's a nice, really healthy gap. So that suggests to us that the unit market probably represents better value. And, you know, I don't think prices are going to come off quite aggressively in the housing sector in Melbourne, but, you know, you should be able to buy with less competition, I think, over the next 12 or 24 months. Median house prices versus, you look at the house versus unit market as well. You know, median house price for housing is running at 900,000 and we're sitting at 635 for the median unit prices. So good quality units, you know, as an entry level asset to buy into the Melbourne market. They haven't moved for a good 7 to 8 years. So they are showing some form of value at the moment in those blue chip suburbs in and around Melbourne. Household lending to owner occupiers, you can see there's been a big dip. So less people are going out there and buying their homes. You can see there's been a dip in investor lending as well. So from our end, you know, there's probably less competition. So you actually can, if you do want to upgrade and you can tie up a lot of your wealth within the family home, capital gains tax free. That's what we're finding a lot of our business owners and doctors are doing at the moment. Stock on market, you can see stock on market slowly starting to rise in Melbourne, which suggests that people are finding it hard, you know, obviously to run their debt. Cash flows are probably, and cash buffers are getting tightened as a result of interest rates and people are able to manage their cash flow. So there's currently 38,000 dwellings on the market for sale. Average days on market is starting to creep up. So from that end, there will be kind of more opportunity to buy really good quality residential stock in the Melbourne market. Vacancy rate, you can see less people buying, so more people renting, and you're in this, we're going through this kind of little bubble at the moment where people are starting to exit because they can't afford to run their residential investments here in Melbourne. So, obviously rents are going to rise quite aggressively, we feel, over the next 12 to 24 months. So if you've got a really good quality residential asset here in Melbourne, our advice is to hold that asset if you can run the cash flow and if it's geared at a responsible level. There's a lot of people kind of stressing around exiting this particular market, but the long-term fundamentals of Melbourne are still very, very strong. It's just that the Victorian are trying to tax every little way they possibly can at the moment to pay off that significant debt that we're in at the moment. Job vacancies are still pretty healthy in Melbourne at the moment. So we've seen a slight dip, but we're looking at an unemployment rate of sub 4.5%. So it's still quite strong. We've still got a diverse industry breakdown. So there's plenty of job opportunities on the ground for obviously higher paying type employment opportunities. Perth, we'll touch on Perth because we always do talk about Perth, but from our end, we're starting to see the affordability index starting to creep up. It's still very, very low in terms of its affordability index ceiling. When Perth has an affordability index ceiling of around 55 to 57%, prices get capped out. So if we're still running at 37% or 35%, we've still got a lot more uplift for capital growth over the next 3 to 5 years in this particular residential market. So there's still really good buying opportunities on the ground in between, say, that $800 to $1.5 million space for AAA rated suburbs within close proximity to the CBD. So we are still buying in Perth, and we're buying quite aggressively. We had 40% of our client allocation last year going to Perth, and we're probably expecting the same for this year. You can see price to income ratio in comparison to Melbourne is a lot more attractive for houses and units. We are buying kind of older style villa units or assets with land at the moment because we think the unit market and the housing market represents value. So there are good quality entry level type assets. You can get into the kind of townhouse market in Perth between 650 and 800. As long as it's got some land behind it, duplexes with a decent sized land holding, we still feel those will perform quite well. And the entry point at the moment for good quality housing in Perth is sitting above that 800K mark. But yeah, very attractive, 5.9 times income for housing. So if you can buy a good quality house, our recommendation is to concentrate on a house. You can see median house prices, obviously a significant time period where we had no growth from 2008 to 2020. The Perth market didn't move for that period for both units and houses. We're really starting to see some uplift. There's obviously a lot of talk around Perth. The economists are now talking about Perth. Banks are now starting to talk about Perth. Owner occupiers are on the ground starting to buy for the first time in 10 years. So we're probably going to go through a very attractive period over the next 4 to 5 years in terms of growth for good quality housing at the moment on the ground. You can see there's a nice little healthy gap between the prices of houses and units. We think both markets represent really good value, and we are buying in both markets at the moment. We still feel we've got another 12 months to 18 months of really good buying in the Perth market until we get pushed out by the owner occupier. So from that end, there's still probably a reasonable opportunity to get into the housing and unit market on the ground. Household lending to owner occupiers, you can see there's a little bit of uplift. There's a bit of uplift for investor lending as well. So, for the first time over a sustained period, owner occupiers are now in the market getting funding to go and buy their houses. And you can see that investor lending is starting to creep up as well. So there's a bit of confidence back in that Perth residential market at the moment. And, it's happening on all fronts at the moment locally. This is the concern to us. You can see that, when we first started buying in Perth 3 or 4 years ago, stock on market was probably hovering around that 21,000 dwellings. It's gone from 21,000 dwellings 3 years ago down to 15,000. So Our buying times to go and buy really good quality residential assets has now been extended. We're finding it a lot more challenging to buy. And the waiting periods for really good quality stock has probably been, it's taking us 8 to 10 weeks to find a really good quality residential investment now. So there's just simply not enough stock to cater for the demand, and those stock numbers have really kind of been lowered. So when you're dealing in a market where the average days is taking 11 days for a house to sell, that is very, very tight, very tight. So our advice is just to be patient. If we are looking for an investment for you, is just to be patient till we find the right asset for you. Perth vacancy rate, you can see the vacancy rate at the moment is running at 0.5%, and look at rents. Rents have gone from $630 for an average house all the way up to $780 a week. And this is in the space of a 2-year, 24-month period. And rents are rising in the unit sector. They've gone from $478 to $570. So they're increasing as well. So, it's a very, very strong market to be buying any type of property within reason, provided it's kind of AAA rated within that catchment. Job vacancy. So job vacancy is in line with Melbourne. We're dealing with an unemployment rate of 4.3%. So very, very attractive from our end. So a lot of job opportunities in different types of industries. Professional and scientific services have taken over a lot of the mining related roles at the moment, and the financial and insurance sectors are starting to grow. So it's really interesting to get a take on the different types of industries that are now being introduced into Perth. And we're seeing some uplift on the ground for, different types of industries opening up. Sydney, as you know, we've been talking about not investing in Sydney for some time. We have not seen an affordability index this high in our time as a business. So the affordability index at the moment, the ceiling usually runs at around that 65 to 66%. At the moment in Sydney, the affordability index is running at 89%. So 89% of a person's income is going to service home loan debt, which is extremely high, and probably suggests to us that, the period of some softening in the housing sector from our end is probably likely. It bucked the trend last year. It went against our advice. Prices still rose by anywhere between 8 and 10% across the sectors. But you've got to be careful of Sydney because it is quite segmented. You've got your waterfront homes. You've got your homes within that 10 to 30 mil space. What we're talking about here is homes that are probably positioned between that, say, 1 and 5 mil space. It is absorbing a lot of these owner-occupiers' debt to run that debt on the household. Price to income, we looked at Melbourne, which was under 10. We looked at Sydney, which was running at just under 6. Price to income ratio for housing is running at 14.2 times income. So, if you're a entry-level investor or you're looking to buy your first home, I think it's very, very challenging. And naturally, we feel that probably the unit market again represents better value, but housing, I think there's better markets to be looking at right now in the current climate. You can see that, during COVID, obviously houses went on a little bit of a run in Sydney. As a result, people were upgrading their homes. We saw a lot of exodus into Brisbane, into Queensland. Saw obviously interstate migration levels picking up in Perth as well. So look, we probably just see a softening of house prices in Sydney over the next 12 months in our view. Nothing crazy, but from our end, just a softening in comparison to other markets. There's a nice healthy gap between the pricing of housing and units. So that suggests to us that we might see a fallback in the median price of housing, and we might see obviously some stabilisation, if not maybe some potential uplift in pricing for units. Household lending, this is no surprise here. Less people are getting money to go and fund their homes. There's obviously less investor lending occurring across the board. So no surprise there. And this is when you're seeing a market starting to soften, you're starting to see stock levels on the market starting to increase. So people are finding it more difficult to run their debt. You can see stock levels have gone from 26,000 dwellings on the market for sale up to 30. Average days on market still sitting at around about 30 days. So it's still okay. from our end. When it starts to creep up to 40, 50, 60 days, then I'd probably have some concern, but it's still moving along relatively well and still holding up. But those stock levels probably will start to increase over the next, say, 6 or 12 months. So we'll just keep our eyes on that stock number and days on market over the next 6 to 12 months. Vacancy rate, no surprise here. Look at rents. Rents have really jumped from $880 a week 2 years ago up to $1,040, and they're probably going to jump another 10 or 15% this year. So, you know, the amount of stock being built on the ground just isn't keeping up with the level of demand. Vacancy rates are 1.3%, so we expect some further rental increases for any kind of unit stock or even housing stock. Job vacancies, again, still very healthy. Unemployment rates are really low across the country. We are seeing some corporate sectors at the moment probably there are some redundancies being made, but a lot of those redundancies that were made during COVID, they're now starting to rehire those staff. And what we're seeing is that they probably fired a little bit too quickly, and they're now starting to try and play catch up, and they're rehiring or putting them on contract-based roles. So that's going to be a very interesting climate, and we'll assess that over the next 12 or 24 months. It's very hard to get good quality staff, and that's probably why, you know, overseas migration or skilled migrants are still being borders are still being open. This is probably the property clock in terms of where we're seeing the national market. So Melbourne, we've got a hold rating for Melbourne and Brisbane. Brisbane's really picked up over the last 6 months. There was some concern with our clients that we saw a softening of kind of house prices and prices weren't moving. We're really starting to see the local kind of Brisbane housing market really improve. So if you own any existing really good quality residential assets in Brisbane, our strong advice is to be holding those. I think Brisbane is still an excellent long-term investment play. From our end, we've still got a strong hold rating for Adelaide. Adelaide's a little bit further ahead of Melbourne and Brisbane. If you want to take a long-term view, we really feel that Melbourne, Brisbane, Adelaide are really good quality long-term foundation assets to keep in your portfolio if you're building a $10 or $20 million portfolio with us. If you do want to reduce debt on the principal place of residence, and a lot of our Melbourne and Sydney clients are doing that, they're taking a position on Perth, and we still think Perth is an excellent play for the next 5 to 7 years. Again, as I discussed before, the entry point's between 800 and 1.5. So there's really good quality residential stock. Still doing a lot of stock buying in Rockingham and Mandurah and Rockhampton. The entry point for kind of Rockingham's probably sitting at around that 600 grand. Rockhampton's probably around that 550. Really great areas to probably take an early position if you're looking to start your portfolio, or you're wanting to take on less debt and start building your portfolio up if you've got too much kind of non-deductible debt on the family home. So those are really good entry points. Darwin's kind of representing value. We're seeing probably some value. Sunshine Coast values are still holding up quite well. Toowoomba, we've got a hold rating for that. That's really moving along, and we're seeing some rental growth on the ground. Obviously, it's the hospitals being built, and that will be completed in 2027. So the Queensland government have still obviously approved 22 hospitals to be built out over the next 10 years in Queensland. So a lot of those kind of healthcare investment will be going in, combining that with the Olympics. Queensland is going on a pretty significant infrastructure rollout or program. So from our end, anything in Queensland we think will do fairly well, provided you're in the right population centre. Units, the unit market is a little bit different to the housing market. So you can see that both the Sydney and Melbourne unit markets are in that buy momentum phase. So if you're looking to buy a long-term asset and you don't have, say, $1.5 or $2 million to buy that asset in Melbourne or Sydney, we probably feel that the unit market represents far better value in that sub $1 million space. You can see that the Brisbane unit market for the first time is really starting to represent value, and for the first time in nearly 10 years, we're really starting to see the unit market in Brisbane starting to move. So from our end, we really see a really good value proposition for, you can buy really good quality unit blocks in Brisbane for around that, say, $2 to $3 million mark, 2 to 3.5 mil mark, really solid net yields on that asset, good land holding, possibly even the ability to develop them down the track as well. So as a long-term investment outside of commercial, we think they're really good quality assets, and we're doing a lot of buying in that particular space at the moment. So this is our runway, our projected runway in terms of where we see the residential growth to occur across all of the capital cities across Australia. So you can see, even with the current cash rate at 4.35 and your likely variable rate will be sitting at around about 6.7, the Perth market is still probably the best value market of all the capital cities across Australia. You can see that the Brisbane market at the moment, if we have some, obviously the variable rate starts to come back and the cash rate starts to come back, we probably see some growth. So if you own property in Brisbane or even Adelaide, our strong suggestion is to hold and ride it through from our end. So Canberra, Sydney, we're probably not touching those markets. And Melbourne, once we see probably a reduction in kind of interest rate movement, we probably will be back in this market fairly soon. Commercial, I'll touch on commercial because we are obviously, a lot of our clients at the moment are getting some form of exposure into commercial, and we have been very, very active over the last 24 months in the commercial space. In terms of the entry point, we are buying a lot of assets for our passive investors that are probably in their 50s and 60s and are looking to sell down, and they want something that's going to be more of a long-term income generating asset. A lot of what we've experienced is there's been still a delay in terms of softening of yields and vendors' expectation in terms of vendors are still out there in the market when they're looking to put a property on the market, still expecting their properties to sell on a yield of around 4 or 4.5%. People have got the choice of putting that money into bank or a bond and generating a 5% yield on that particular property, or that particular opportunity. So from our end, I think there needs to be a really strong education process with our investors. I think there's going to be a softening of yields in particular sectors as well, and we are kind of looking at and picking the eyes out of the market for these commercial opportunities. And we have been buying a lot more in that 3 to 6 mil space. We're doing a lot of industrial investment up in Queensland and Brisbane. I know the commercial team's been quite active up there and looking at assets that are generating yields of 6% or more, with really good quality defensive tenants on long-term leases. We are doing a bit of stuff at the moment. We're probably not touching office at the moment unless we have a kind of more of a long-term, we can develop that asset. So from our end, we are very, 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 very active in that kind of 2 to 10 mil space. But the yields at the moment are still very, very low. And we're probably, from our end, just being very selective in terms of what we're buying. So from our end, obviously interest rates are still causing clients' ability to kind of cash flow these investments. Obviously, making sure that you've got your cash buffers in place are really, really important. We think things will probably get worse over the next, say, 2 years. We still feel that all of the rental properties that we're currently managing as a business, we're increasing those rents. So that's taking some of the pain away in terms of managing these portfolios. We really think there's still really strong opportunities to buy good quality growth assets in our approved regions between now and over the next, say, 12 months. If you've got assets in Adelaide, if you've got assets in Melbourne, if you've got assets in Brisbane, our strong recommendation is to be holding those particular properties. The only reason you would probably sell down some of those properties is if you're looking to upgrade your principal place of residence and reduce your non-deductible debt. So a lot of our clients that are in their 50s and 60s are now looking at commercial. We'll probably touch on some of the examples that we've purchased. So this was a example of a unit block that we purchased in Fairfield that Alex Gusson, the commercial team, bought for a client. The particular agents were chasing kind of 3.1 to 3.2 on this particular asset. We picked it up for 2.755. It's getting an annual rent of 80,000. There's an ability to develop at the rear. It's very ugly looking building, so it needs to be rendered and tidied up. But from our end, our view is that we'll probably increase those rents, undertake a cosmetic refurbishment on it, and it's got the long-term kind of development uplift of that particular asset. So that's a really good quality sub $3 million investment. This is a medical precinct we bought for a passive investor. This is on just over 1,000 square meters, corner block, the ability to go to 3 or 4 levels, 2 kilometers out from the Adelaide CBD. So a really great long-term investment that we picked up for 4.4 million. This is typical of what you can buy in Perth. So very ugly looking estate style homes, good block of land. The land value itself would be worth kind of 750, and you're paying about $150,000 for the dwelling. You're probably within a very close proximity suburb in Perth. But that rent will probably increase quite dramatically as well. So good quality property to hold for 5 years and then realise once it reaches a value of 1.4 or 1.5. This is typical kind of the Rockhampton type assets, kind of $530,000 purchase price. The net yield was 3.23. Ugly looking, but I think, the Rockhampton market is a very good entry level type asset to consider if you're looking to start your portfolio, if you want to take on less debt. This is one in Brisbane that we recently purchased for a long-term, passive investor, good size block in Aspley. Brick. A lot of the homes in Brisbane are more weatherboard, which require a little bit more maintenance. So it's very hard to get brick homes in Brisbane, but a good long-term investment that will get a very good rental, and from our end, a good quality suburb as well. Now we're expecting our IM on our kind of hospitality fund that we're about to launch very shortly. So if you do want more information on our fund, Ryan Mitchell and Megan at our office will send through the IM, but we are expecting that to come through. This advice is just probably more of a generalized view in terms of what it is. So from our end, it will be a kind of $30 million fund across 1 or 2 really good quality hospitality assets. We've obviously developed an investment committee where we have someone on our investment committee that has undertaken the refurbishment of over 21 venues across Victoria and WA. So they've come on our investment committee. They will be undertaking the fit out on these particular 2 assets that we'll be looking at, 1 to 2. We've got a target IRR on the fund of 14%. The kind of minimum investment is 100,000. We're going to be dealing with one of the kind of second largest hospitality operators in the country as the tenant. So we've got a really good quality long-term lease, and we'll be looking at assets that we can create some value, do the fit out on that particular property. And then once we do the fit out, we can probably get some uplift for our clients in year 3 on that particular fund. So if you are interested, just reach out to Ryan or Megan at our office or send us through an email, and happy to send through the IM when it's ready. That concludes the presentation today. So I'll hand it over to you, Paul, for any questions. Thanks.
Thank you, Phil. I haven't had any questions come through on their messaging. I'm not sure if anyone has any. Otherwise, we will be able to finish it up there. No, I'll listen. If you do have questions, you can obviously reach out to your advisor or Philip or your relationship manager. So please feel free to do that. Otherwise, have a great Wednesday afternoon, and we'll see you all at the next update in about 3 months' time. Thank you.